Output in May growing at its fastest pace in over 2 years, giving investors reason to doubt some of that recent worry about growth. The S&P Global US PMI Composite rising to 54.4 this month. Now the move higher led by the services sector, which saw business activity registering the fastest growth in a year, reversing a slowdown from prior months. And this was accompanied by expansion in the manufacturing sector as well. Here to dig into this data, we want to bring in Chris Williamson. He's S&P Global Market Intelligence Chief Business Economist. Chris, it's great to see you. So let's talk about this print that we were just getting. And real quick, I also want to take a look at the market's reaction, because we do have the S&P right around the flat line, but the story is really in the bond market. And we have yields here pushing to the upside. So, Chris, I'm curious, from your perspective, what does this print, what does this report tell us just about the state of the U.S. economy right now, and maybe putting to rest some of those fears that that economic growth has been weakening?
Well, precisely that. Yeah, we'd had some weakening growth momentum in this survey up to April, 2 months of quite markedly slower growth. And that's reversed into May. We've got a much stronger growth picture here. It's the fastest for just over 2 years. And accelerating particularly sharply in the service sector. This is obviously a very interest rate sensitive part of the economy, and that acceleration in growth is clearly one that's going to worry the central bank in particular, that you've got some building demand pressures here in the economy again.
Chris, I know that you called the April data just a bit of a wobble. Does today's data feel different to you? I mean, this is what, an 8-point standard deviation? Like, this feels like a bigger move off of this PMI.
It's a big jump. We've been surprised by the weakness in April. There's possibly the timing of Easter often creates havoc with the numbers, but we're getting some other data coming in, such as the housing data, which were weak in April. So it looks like there was a soft patch in April, but it is difficult to disentangle how much Easter's affected that. But we do see some underlying factors here that's improved business confidence, which is feeding through to better spending numbers. And a big factor here has been the market. To be honest, we've had the earnings season that was better than many had expected, an indication that companies are able to make good returns in this higher for longer environment. And that's led to this resurgence in business sentiment and business spending that's fed through to this upturn in activity. So if you like, some of the fears that were mounting in April about how higher interest rates might be affecting the corporate sector are being allayed.
Chris, what does this tell us just about how strong or how much stronger GDP could potentially be here in the current quarter?
Well, we're running at levels that are consistent with around 3% annualized, just over that, 3% annualized GDP growth in May. So it looks like another strong quarter. I think the Atlanta Fed nowcast is in similar sort of territory. So yeah, it looks like it's going to be a good quarter again. So defying many expectations of a slowdown.
Chris, is it enough, do you think, for the Fed to hold off potentially even longer? And then that also brings into the question whether or not maybe another rate hike should be on the table. Where do you stand just in terms of the thinking surrounding that narrative and that conversation?
Well, those headline numbers on their own are suggestive that they're moving into more of a rate hike than a cut territory, right? But we do have some moderation of inflationary pressures coming through. It's only modest, but the service sector in particular, the rates of inflation we're seeing in this survey in the service sector are among the lowest that we've seen in the last 3 years. But that still leaves the indication of the survey of an above 2% inflation rate, just above, but it's still annoyingly above that target, suggesting again that this last mile to target is proving really frustrating. A positive sign, if you like, here was that we had 2 months of falling employment, as there's a lot of caution about the environment going forward, especially with the elections coming up and geopolitical uncertainties. That's leading to some pullback in hiring, and that's helping to alleviate some of those wage pressures in the service sector. So we need to watch how that progresses over the next couple of months. If that persists, then we're still on course for some rate cuts later in the year. But as it stands, if we get this big pickup continuing or even gaining momentum, then we've got to be looking at whether rate cuts are the right thing to be doing.
Well, Chris, let's talk about the labor market here. We know that Atlanta Fed officials this week at their conference were talking about how CEOs are telling them that they are pulling back on hiring. At what point does that indicate a broader risk to this market that could stall some of the growth that we're seeing, keeping fears about the economy at bay?
Well, yeah, so we've had 2 months now of falling employment. That's been led by the service sector. It certainly looks like the service sector hiring trend is cooling quite markedly. However, it is being supplemented, if you like, by an upturn in manufacturing. We know there's a lot of investment going on in manufacturing at the moment, expanding capacity, the CHIPS Act and the IRA. They're helping to expand that manufacturing base, and we're seeing this more balanced economy coming through where growth is slowing, perhaps in the service sector, according to the jobs market, but starting to pick up in manufacturing, which leaves this overall, I mean, manufacturing is still a small part. So it leaves this overall picture of a slowing jobs market, but not a collapsing one. So I think that leads to a suggestion that you're going to see some weaker pay pressures come through, which is going to help the overall inflation picture. But at the same time, that weaker job market, weaker pay growth is a negative for consumer spending. So it's going to be interesting to see how this plays out. But what I think the important takeaway here is that at the moment, we still have this above trend inflation rate that's going to be front of mind. And even if the labour market is slowing, those wage pressures remain elevated by pre-pandemic standards to the extent that it's causing some nervousness.
Certainly, and that's why we continue to say we just need the Goldilocks, perfect amount of heat and coldness in all environments here, Chris. Thank you so much for joining us and sticking with us through those tech issues. We appreciate it. That was Chris Williamson. He is S&P Global's Market Intelligence Chief Business Economist.